All right, let's get right into it. For as long as I can remember, we've all been told the same thing about inflation. When prices start creeping up, stocks are the place you want to be. But what if that old wisdom isn't just a little off? What if it's dangerously wrong? Today, we're going to tear down that idea and find the one single superpower a business absolutely needs to survive.
You know the classic argument, right? It goes something like this. Stocks aren't just pieces of paper, like bonds, which are tied to a fixed number of dollars. Nope. Stocks represent real ownership in actual productive things. Factories, brands, technology. So it makes sense that as the dollar gets weaker, the value of those real assets should float up with inflation. Seems logical.
But this is exactly where the story gets tricky. Because when you actually look at the historical data, that neat little theory just falls apart. During the worst periods of inflation, the stock market as a whole often got hammered, delivering pretty awful returns after you account for those rising prices. So what gives? What are we all missing here?
Well, to figure this out, we have to jump in a time machine and go all the way back to 1977. That's when Warren Buffett wrote this legendary article for Fortune magazine, and he basically called out the entire market for not getting it. He put it so bluntly, saying it is no longer a secret that stocks, like bonds, do poorly in an inflationary environment. Whoa, that single idea is the key to everything we're about to talk about.
See, Buffett's big insight was that stocks, deep down, behave a whole lot more like bonds than anyone wants to admit. Now, I know that sounds totally nuts. A bond pays a fixed coupon, right? A company's earnings are supposed to grow to the moon? Well, yes and no.
What Buffett did was he looked at the return on equity for all of corporate America over decades and decades, and he found something incredible. Through all the chaos, wars, recessions, tech booms, that return barely budged. It just hovered right around this number, 12%. He actually called it the equity coupon because it was as surprisingly steady as a bond payment.
And that, of course, leads us to the billion-dollar question. If businesses are just chugging along, earning this reliable 12% equity coupon, then why does high inflation completely destroy the party for investors? Where's all that money going?
And here is where Buffett gives us this brilliant and, let's be honest, kind of horrifying metaphor. He calls it the corporate tapeworm. It's this invisible parasite, a hidden tax that inflation levies on a business, and it just eats away at your returns before you ever get a chance to see them.
So what is this tapeworm, really? It's the simple, brutal fact that when prices are rising everywhere, a business has to spend way more money just to stay in the same place. Replacing your inventory costs more, upgrading your machines costs more, everything costs more. And this tapeworm, as Buffett says, just eats first. It consumes all those dollars it needs, no matter how healthy the business is supposed to be on paper.
Just look at how devastating the math is. Let's walk through a typical case. A company earns its 12% return. It gives half of that, so 6%, back to shareholders as a dividend. It keeps the other 6% to reinvest and grow the business. But, and here's the killer, if inflation is running at 7%, that company actually needs more than the 6% it kept just to replace its stuff at the new, higher prices. So what's left for actual growth? Nothing. Zero. The tapeworm has officially cleaned the plate. Okay, so is it game over? Is every business just doomed when inflation hits? No, not at all. Buffett also identified the antidote. He found a kind of business superpower that allows a very select group of companies to fight back and actually starve that tapeworm.
And that superpower, the absolute holy grail for an investor, is pricing power. It is everything. It's the simple ability to raise your prices to cover your own rising costs, protecting your profits. If a business can do that, it can keep generating real, actual returns for its shareholders, no matter what inflation is doing.
But let's be clear, pricing power isn't just about cranking up the sticker price. Any company can do that. Real pricing power is the ability to do it and have your customers stick around anyway. It means you've built something special, a brand people love, a product they can't live without, or it's just so painful to switch that they have no choice.
Now, it is so important to understand this next part. Not all pricing power is the same. I find it really helpful to break it down into 3 different levels, from the absolute best to the most fragile.
So at the very top, the absolute peak, you've got brand power. This is the magic level where the high price is actually part of the appeal. Think about a company like Hermes or Apple. People aren't just putting up with the price. They actively want the expensive thing because it signals something. This is the ultimate competitive mode.
Okay, one level down, you have structural power.
With this one, customers don't necessarily want to pay more, but they kind of have to. Their business is just too deeply tangled up with the product. Think about trying to rip Microsoft Office out of a big corporation, or telling an architecture firm to stop using Autodesk. The headache and cost of switching is so massive, they'll just swallow the price hike.
And then, at the bottom, we have the one you have to watch out for: situational power. This is the most deceptive kind. This happens when a company gets lucky because of some temporary market shock. A shipping company when ports are clogged. The profits can look amazing for a little while, but that power just vanishes the second things go back to normal. It's a windfall, not a real long-term advantage.
So here's the bottom line. As an investor, your entire job is to figure out the difference between durable power, which is built on real customer love or need, and temporary power, which is just dumb luck and timing. One is a fortress that can stand for decades. The other is a sandcastle that's about to get washed away.
Okay, that's the theory. But how do you, as a regular investor, actually find these amazing companies with real pricing power? Well, the good news is you don't need some secret Wall Street algorithm. The clues are right there in the public filings for anyone to see.
All right, first clue, and maybe the most important, look at the gross margin. This number basically tells you how much profit a company makes on every single thing it sells. A business with real pricing power will have fat, juicy margins that stay high and stable even when their own costs are going up. They just pass it all along.
The second clue is hiding in plain sight. You just have to listen. I'm talking about the language that executives use on their quarterly earnings calls. You start to hear the difference between strength and weakness. Strong companies say things like, "We saw no meaningful churn." Weaker companies talk about promotional activity or competitive pressures. It's like a code, and once you crack it, you can't unhear it.
In the end, everything we've talked about really boils down to this one simple question. Can the business you are looking at protect its profits from that inflation tapeworm? Does it have the power to starve the parasite, or will it just get eaten from the inside out?
So, here's your takeaway, your cheat sheet. This is what you're looking for. High and stable gross margins, the ability to raise prices without customers running for the exits, customers who are locked in by a great brand or high switching costs, and a management team that speaks with total confidence about their pricing. If you find a business with all of these, you've probably found a winner.
Seriously, once you grasp this concept, it changes everything. It completely shifts your focus away from just looking at reported earnings and toward the actual quality and durability of those earnings, especially when things get tough.
So I'll just leave you with this thought. The next time you're looking at a potential investment, don't just ask the obvious question, is it growing? Instead, ask the much, much more important question. In a world that is always changing, does this business truly have the power to set its own terms? Because that's the question that separates the good from the truly great.